Hello, everyone, and a very warm welcome to today's Major Markets Update for Saturday, March 4th, 2023. Thank you for your patience and understanding while I was recovering from my medical leave on Friday. And normally the updates are after market close on Friday anyway, so we're not missing a single beat. As I wrote on Thursday while I was sitting in our doctor's office chair, so to say, as long as Thursday's low holds, which is Wednesday's low for the Dow Jones, we can't move higher. And thank God you all were buyers on Friday. Market went up very, very nice. The wave count to the downside since the February highs looks complete. Sentiment is down the drain. Market breadth is improving. I think we have a lot of good things going to look for higher prices. Bottom line, as long as this week's low holds, translates to, from a trading perspective, should, if you want to, be used as a stop loss if you're long. And then we can start to look for 4,300, NASDAQ about 13,000, Dow Jones potentially into the 35,000, I believe it is, if not higher. Actually, no, 36, 37,000. Sorry for some of these numbers. That might not be entirely correct till we go over the charts, but it's just a lot to go by. So the bears continued to fail to push the bulls off the 39.40 edge. Every single time they tried. Intraday spikes, I don't really care too much about. They're nice for the final Elliott Wave counts, but in the end, the market works on closing prices. All your indicators, market breadth, institutions base their buying and selling on closing prices. It's the most important print of the day. When the market opens, all we want to know is where it's going to close. It never closed below 39.40. And with that, the bears have failed. Not until we see a close below 39.40 will I look higher. Then on Wednesday, I found that we need to see the S&P 500 back above 4,028 and that short-term downtrend line, I'll show you the chart in a minute, to know the current decline is over. That has been achieved. I'm now looking for a short-term top around 4,060, 4,070. And you see the other numbers for a wave A, then a wave B, and then a wave C, as I expect the three-wave pattern to continue for the foreseeable future. On Wednesday, we found that the Dow Jones held the key as it looked rather complete for a five-wave C-wave lower, and it sure was. At the low, which was only 0.5% above the 33,300 level, we had a fantastic, pretty much sees a relationship for what we would say a regular flat wave 2/B. Now we need to get back above Monday's high and especially last Thursday's high to know that the decline is over, and that's been achieved. So on Wednesday, we said we should expect a counter trend rally of at least 3 waves in the opposite direction, because we can always subdivide, right? We could just have an A wave and then a B wave, another C wave. The single correction can be a double and a triple until we start breaking, of course, above key levels. So one of these key levels in the last point is 4170. If we go above 4170 on the S&P 500, then we're not going to subdivide lower anymore. So the ending diagonal remains the preferred scenario that we're now in this wave 5 to 4300, etc. Sentiment is extremely negative. The National Association of Active Investment Managers has been spot on, being a contrarian indicator. I'll show you that. Also, the AAII is extremely negative, so there is plenty of room to the upside for sentiment. The wave count was complete. Market breadth is improving. The PMO buy-all, sell-all indicator has been on a buy for the last couple of days. So that one's been correct since it gave a buy. We do have to remain mindful of the alternative wave counts, which will be off the table if we go above 4170. That's the bottom line of today's presentation. If you want to see the details, keep watching. If you don't want to see the details, then this is all you need to know. Stop losses, all this good stuff, please read it, please read it. This is all there for you to learn from. It never hurts to learn something. And if you have something for me to look at, please let me know. These are all the other ways you can use me to your advantage. Please do so. All right, there's more to the markets than most people think. And if you want to get good at the markets, it will take 10,000 hours, just like everything else. This is then the bigger picture. We are in this larger B wave, remains the preferred scenario, and most likely in this black C wave. All right, so the lowest end was 41.96. Well, we got to 41.95, so technically we've done the minimum requirement, but it looks incomplete. That's my whole point. It looks incomplete until we start, of course, breaking below key levels. 39.40 is the first line in the sand. So this is a bear market, so no need to sit on long positions for all that long. Let's start off with the Dow Jones. The Dow Jones topped here late November last year and has since been consolidated. This looks like a nice technical bull flag that has been developing. All right, it starts here, let's say, at 28,880. It ends here at 34,600. So that is our rally. So then we take that, we take 34,600, just round numbers, minus 28,800. We have a 5,800 point rally. And then we bottomed here at around, let's say, 32,500, somewhere around there. Okay, and we add 5,800 to it, 32. Gets us to 38,300. So I'm going to update the slides, okay, and say that we can then go to, ideally, about, for the Dow, 38,300. Okay, that's how we go about. If you don't know what I'm talking about, this is then the flagpole, the pennant, as they call it. This is then the flag, and we're going to add that flagpole, and of course I can't put it on the chart, to it. Okay, so there, from the bottom. So this is, of course, our length of the rally, okay, which was from, as we said, 28,800 all the way to the top, let's say 34,000, what did I say, 600. And then we add it from the beginning here, 32,300. So it gets us to around 38,300. We're going to zoom out, and then we kind of get an idea of where that will get us. As you can see, we could make new all-time highs. It's very possible. Why is that possible? Because the Dow Jones could still be in a bull market. I hope I'm going to find the right chart right away. And that is this wave count. 1, 2, 3, 4, 5. All right, please keep that in mind. This is still a very possible wave count for the Dow Jones. That's why we've labeled it 1/A, B/2. We don't know yet if it's going to be 3 waves or if it's going to be 5 waves. The Dow Jones can still try for a new all-time high. So the bull flag pattern is, of course, shown nicely here as well. The triangle path that we had originally broke down, but now we have, of course, a nice bull flag pattern. So that is the flag. This is our flagpole, right? And then we simply add the length of the flagpole to the bottom of the flag. And that gets us right there, okay? On a breakout, we need to see, of course, the breakout, and that is then our minimum upside target, potentially much higher. And this is why we need to hold, of course, the lows. We have a nice, loud and clear, of course, support zone right here. This is now our support zone. Okay, this is our support zone right here. If we break below it, I'm going to put this in green because we're looking for higher prices. This is then our flag. Okay, looking for higher prices here, looking for higher prices. And this is, of course, now support. We have resistance here, there, and this is now support. So this is why you want to put, if you want to desire to go along, a stop at around those levels. This is support. Because if we break below support, we have, of course, the opposite symmetry, and we can easily go to this level. Okay, easily. Now we can play a little bit around with, of course, the exact width of this flag. Is it this or is it this? But you get the idea. This looks like a bull flag. It is a classic technical pattern, and it will kick in on a break above resistance. And then we have a nice technical breakout level. This is, of course, resistance. Every single time, remember how agonizingly frustrating this was. bumped its head into it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. And of course, we had a false breakout here. That's the Dow Jones. Still looks bullish. We're holding the 200-day. Looks good. We'll go into a little bit more detail, of course, using the other indexes on how this path is going to fill itself in. This is the NASDAQ 100. Still looks good for this wave 5. We technically, on a closing basis, have bottomed in the ideal wave 4 target zone. Yes, on Thursday, we dropped below it on the open, but no harm done. The bears failed to close the NASDAQ 100 below its 200-day moving average. As long as they can't, we have to look higher. So that is, of course, now our line in the sand. So now I'm going to look here to about 13,250. So let's put it on the charts, 13,250. Okay, that is our line in the sand. The 200-day moving average, closing basis, or first day's low. We have nice positive divergence. We have maybe soon a buy signal on the MACD at this above the zero line, which is bullish. And once we reach those levels around 13,250, we'll reassess if that is wave C of B, or are we going to get 5 waves with a 4th wave decline and then another 5th wave. To be determined. We're absolutely not there yet. Shorter term, this is the NASDAQ 100 hourly chart. Please have a look at all the blue target zones. All the blue target zones were the target zones I forecasted, and all of them have been reached. This is where we expected wave 2/B in red to bottom. Did so. A in green to top, B in green to bottom, A to top, B to bottom, C to top, A to bottom, etc. Did we get it wrong here? Yes, we got it wrong. We got it right. And then, of course, at some point you get it wrong. After about 10 times right in a row, I know I'm going to fail. That's just the way the market works. Did we bottom on a closing basis in this ideal target zone? Absolutely. I think we nailed it. That we got a little bit below here at around 11,825, I believe the low was. 12,000, not even. Yes, that was the low. Sorry, that was the low on Thursday at around 11,825. That's it. If we're looking at 11,880, you got to give the market a little bit of leeway. We never top exactly in the middle or on the top or the bottom of the target zone. That's why it's a zone. So I'm now looking here for a rally to this target zone box, a drop, and then a rally, kind of akin to what we saw here in January. This is what we're going to expect, with, of course, some variation because the market rhymes but never repeats itself. We had this cracking positive divergence, and it finally kicked in. As you can see here, it takes a trading week and a half before it finally kicked in. We're very overbought, so don't be surprised if we kind of fall off the cliff. This has kind of been the modus operandi for the market. Every time we get extremely overbought, we fall off a cliff, as you can see here. Like here, 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 and we might do so on Monday. What I prefer to see on Monday is that we rally a bit into the open and then we drop, kind of suck in the bulls that are late to the party. Then we drop for wave B and then wave C. Why is the C wave target zone so large? Because we don't know exactly where wave A is going to top. I think around 12,400 plus or minus 100. We don't know exactly where wave B is going to bottom. It's around 50%, just like we did here, about 50%. So with those two variables, we don't know where wave C is going to top. The uncertainty just becomes higher. But you can see here, we still have 12,900, 13,300 on the table, which matches really nice here with 13,250. 13,250. That remains my upside target for as long as we hold this week's low. Semiconductors look good as well. We finally broke above this target zone box for wave 4. And we closed above the 20-day moving average. Those were the two requirements. This is a good sign. It's not the absolute, but it's a good sign that wave 5 is underway to around 3,350, potentially 3,370. Okay, somewhere around there, 3,350 plus. That's what I'm going to look for, as long as we're going to hold Thursday's low. Nice bullish reversal of support. As you can see here, this was resistance in December. And we kind of gyrated around it in January, and it's holding here in February So this is good. This is a good sign. I like it. If we get a buy signal, it's above the 0 line, which is a strong signal as well. And then we're going to look higher to the target zone. This is the S&P 500 short-term Elliott wave count, hourly candles. As you can see, we had the January to February rally as 3 waves. 3 waves is technically, in purest Elliott wave, a Y wave. I simply count it as ABC. It's 3 waves. Why complicate the already sometimes hard to understand Elliott wave with additional letters? The reason why we have those additional letters can be discussed, but we have simply 3 waves higher. It's part of a corrective structure, which can be part of a diagonal, okay? And then we found on Wednesday and Thursday that we have to break above this downtrend line, and we did. On Thursday, we still closed right at it, leaving things to be desired. Friday's open, we broke above it, and we've broken above 4,028 with bravura. It's really been a great breakout, and we're kind of, well, this box is just there to highlight what we were looking for. So this is not a target zone, but this is what we were looking for. So we break above it, we got above 4,028, boom, we're done. With that one, I think we have a nice symmetry between wave 2 and wave 4 in time. So I like it. I think we have a nice flat wave 4 here, where we have wave A, wave B, and wave C as a irregular running flat wave 4. And then we also have technically 5 waves lower for what I believe is a ending diagonal wave 5. So this is then wave 1, which is an ABC. This is wave 2, which is of course also clearly an ABC. And then this is wave 3, which is also a ABC there. And then of course we have so much little data on wave 4, but that is this little spike up here, wave 4. And then of course the final wave 5 of C of 4, because the ending diagonal remains our preferred scenario. There, wave 5. So this is ABC for 1, ABC for 2, ABC for 3, ABC for 4, ABC for 5, 3, 3, 3, 3, 3, ending diagonal. This might actually be of a expanding kind. Looks good, not too shabby. So we're going to look here for a high at around 4,070, plus or minus 10. A drop here to about 4,000, plus or minus 10, and then a rally to about here. Again, I don't know the exact C wave and target zone because wave A has not been determined, neither has been wave B. But please remember, using the NASDAQ 100, we have some very good accuracy here. So I expect this to top out pretty soon. Again, we're quite overbought, so don't be surprised if the beginning of the coming week is going to be weak. This is our preferred Elliott wave count. We're holding the 200-day moving average. Again, no close below 39.40. We have positive divergence, and we have now 2 up days in a row, which we haven't seen since this B wave high. So this looks great. I will present some alternatives on why we therefore need to place stop loss at Thursday's low. Remember, there's no guarantees you will make money in the market. Your first, if you so desire to play the market, your first responsibility is to not blow up your account. If you can make a profit, great. So the second alternative is that we have this ABC. So we're going to get a 5-wave C wave to about 4,375. Maybe now a little bit lower because we didn't stall at 39.40, but we dropped to as low as 39.28 in cash. I think even 39.12 on the futures market. Some people ask me about the futures market versus the cash market. The futures market has most often more waves. Why? Because it trades longer than the cash market. The cash is king. They will always align, but cash is king. That is the final arbiter. We held the 200-day moving average. We're back above the 50-day moving average. And we are back above last Thursday's high, which was 4,028. With bravura, looks good. Don't think it's going to be easy because if you look at the uptrend since the October lows, I will put on slide, we have not had more than 3 updays in a row. We have already now 2 updates in a row. So please consider that from a short-term trading perspective. 1 update in a row, 2 updates in a row, 1, 2, 3 updates in a row, 1 update, 1, 2, 3 updates in a row, 1, 2 updates in a row, 1, 2, 1, 2 updates, 1, 1, 1, 2, etc. There's not more than that. So that shows you how erratic this market is and that you have to trade quick. So expect something similar like this to develop for this C wave, but then in 5 waves. If this is a simple ABC versus a 1, 2, 3, 4, 5. Now I can show you, I'll show you that later. The other alternative is shown here. This is still on the chart, and we're dealing with a very large B wave. So far, we've completed wave A of this wave B. Okay, we're going to get this. So now we're going to rally to the same target zone, 4,070, 4,100. We drop back to about 4,000, and then we rally. So this initiation part looks quite similar to what I showed here, A, B, C. Okay, but on this wave count, we'll stall below 4,170. If we get above 4,170, this one is off the map. So this is still very possible. We're going to top out, and we're going to bottom, and then rally, and then a bigger decline. So it is still very possible. This would then be a B, and a C, okay, or WXY if you so desire. And WXYs are technically W, always 3s. And the WX. This is for the Elliott Wave purists, WXYs. It is kind of like a connector wave, but since it's 3 waves, why not label it ABC? That are all the indexes I want to cover. So we have some scenarios. Oh, of course, before I forget, and the most bearish, of course, wave count is this 1, 2, 3, 4, 5 scenario. It is still possible that we've already topped for this blue wave B. So that's why we don't want to take any prisoners and make sure we get out before potentially the real, you know what, it's the fan. It is still possible. I don't think so, based on the Dow Jones and the NASDAQ 100, as well as the semiconductors. All right, the preponderance of the evidence points to the fact that we're going to trade higher. But we must be ready for the possibility we will not. Always prepare your portfolio for disaster. So here we have some nice setups in place. This is the McClellan oscillator of the S&P 500. It measures the number of stocks that are advancing and declining, standing still in the index. And we've had some nice positive divergence here late February. So we went lower, but less stocks were participating. Similar here in late December. Took a long time here in September, October, a little bit less here in August, September, June, etc. Every single time we got at the minimum a pretty decent rally out of it. So that looks good. Some of these rallies were 4 days, as you can see, but considerable upside potential. That's, I think, what we're currently seeing. So this supports the notion of higher prices as well. As I said on Thursday, at least 4,100, above 4,170. I think we're going to go to 4,300. This means that the summation index is now starting to turn back up. The summation index adds yesterday's reading to that of the day before, that, etc., etc. So it's cumulative. And as you can see, we've been very oversold. We were very overbought and now very oversold. So the path of least resistance is back up, but I don't have a buy signal. This indicator, the new lows, the 52-week new lows, has remained benign on the NYSE. The NYSE is the broadest index, so to say, it pretty much contains all things that can be traded on the New York Stock Exchange. It's been below 50, so this is not a market crash similar to what we've had all of 2022, but nothing but a overbought pullback. The NASDAQ has been a little bit higher, but still no real concern. Nothing over 500, not even over 200. And we're back to benign levels. Can always change, but this one tells us the pullback has been benign. and more, as I said on Thursday, a profit taking with no panic. Panic are these type of levels. This is where everything at the kitchen sink is thrown out the window. Everything, women, children, dogs, cars, houses, everything is being sold. Literally, not now. This is a different environment, a different decline. Can it change? Of course. But so far, we can only work with the data at hand. And when the data changes, we change accordingly. That is the evidence base. And the evidence tells us this has been a benign overbought pullback. The PMO buy all, sell all indicator has been on a buy since late February, remains on a buy. So also this one supports higher prices. Fear was reasonably high at the lows and is subsiding now. So we might soon see that short little pullback before we can move higher again. Now this indicator is the NAM, the National Association for Active Investment Managers, so supposedly professionals. Again, it is a survey, so there's a difference between what you say and what you do, of course. But if we look at how exposed or overexposed these money managers were and underexposed as well at highs and lows, we find that these money managers are underexposed. The blue line is the long-term moving average. They're underexposed at all the important lows since 2022. Since we're in a bear market since 2022 and have no evidence that we're in a bull market, we need to compare apples to apples. So I do only want to compare what we've seen since 2022. Every single time we peak, they're overexposed. Every time we bottom, they're underexposed. Again, very heavily underexposed. So I think this is a nice sign that we're going to move higher. How are mom and pops doing? Extremely bearish. Extremely bearish. 44% are bearish. They think that over the next 6 months, the stock market won't move higher. Okay, we've moved up slightly from the number of bulls, but that's noise. So this is extremely bearish. So from a sentiment perspective, there's a lot of room to grow. Seasonality. Seasonality is also important. We were looking for a low late February. Now we got and then a rally into the early March and then kind of sideways. This is all years for the S&P 500, and this is only for pre-election years. It is kind of a similar pattern. We would see a low around late February, a rally into early February, weakness, and then a rally. Okay, so we're seeing the same thing for either all years or when we only look at pre-election years. And since we bottomed on March 1st, we might see this top a few days later, which is fine. It's still the same pattern. Okay. Again, it's not about the absolutes. It's just about the relativeness, about which way the market is going to move. Bottom, late February, early March. These dates are, of course, plus or minus a couple of days. It's not set in stone 100%. Then that must be the date. Sometimes is, but most of the time it is a guideline. And then we should see higher prices. Now, another one, and I don't share this one with you often, is junk bonds. So junk bonds is, of course, risk-on type of investment. And as you can see, it is holding the 200-day moving average and starting to move back above the cloud. It is confirming the rally in the stock market, especially since Thursday's low in the junk bond was a higher low. So that's quite interesting. Now, in Wednesday's video, I also showed you work of other people because, as you know, 2 no more than 1. And we found that for some analysts had it wrong, but it was not to point out that they're bad. But what we wanted to point out is that we can't get it right all the time. But what is most important, and I wanted to share this with you, is what Xenia Taubina then shared. She said, yesterday's bullish setup, this was on Thursday, she wrote this, provided her tight parameters and it broke. So the bullish setup broke. And she honestly says, and this is very, very important, not all setups play out. They just don't. But how you adjust when something else happens is the hallmark of a good analyst and trader. You anticipate, you monitor, and adjust. So you anticipated the bullish setup. It broke because we have, of course, key levels that must hold. And it didn't happen. And this is key, and I have to always share this with you. All right? How you adjust is the difference between amateurs and professionals. You adjust accordingly, and it's okay, you're wrong. Get out, trading, change your point of view and your analysis, and off you go. Similarly with Sakmanis, he now has a nice ABC pattern as well. All right, it's okay. We can't get it right all the time. Looks complete here for wave 4. This is the futures market for NASDAQ. And looking also here for top around 12,400, drop back to about 12,100, and then rally in this larger ABC, as I shared with you before. Finally, work by Pretzel, and he starts to realize that we also might be in this ending diagonal. Now he has it as a regular contracting ending diagonal, very possible, but again, it looks at around 4,300 for this wave 5. So he is also coming along with the idea that we are, of course, in this potential wave 5 of a larger ending diagonal C wave. So I like it. I think that we have a good amount of data that all point to a rather similar outcome. That is really all I have for today. I wanted to share one more time the summary slide, critical, and I think everything has been working to plan quite nicely. We had a few days in February that we didn't get it correct. It happens once in a while, and now we know that we should be looking for a short-term top, short-term weakness, and then again short-term strength. For as long as we're going to hold last week's lows, I'm going to look higher, with, of course, the ABCs to follow to the new uptrend highs. And you saw for the Dow Jones how high it can go if we really get this bull flag pattern going. There's a lot of negativity out there. Internally, things are improving. So I think the primary expectation for higher prices, with, of course, the daily variations in between, should remain as our preferred path. Take care, trade safe, and I see you all on Monday. Bye.